of the high, the low, and the close. So when we talk about some of the markets going up or down, we're typically we're going to be talking about the typical price and using only the close as our frame of reference for a given time period. So we are going to look today at a market that perhaps is one that I don't know what kind of a background you have or what your thinking is. And if you think and what's happening to banking, what's happening to the financial system, what's going on, in general. But I think one of the things you can probably agree in general is that the market is going in generally pretty straightforward. Is gold that is moving to the upside. You can see that we have on the screen here, we've put up a chart. We put some of the indicators on there already. Let me back up here a little bit and talk to you a little bit about what we have on the screen so far. First of all, when you look at gold futures and when you look back a ways, if you're an old timer, you may recall that gold in January 31st, 1980 peaked at $873 an ounce, and that was kind of one of those wild days. At that point, we were talking about something like 15% interest rates and lots of things that were a little bit scary in terms of being an investor, because there were so many things going on that were kind of beyond the range of normal in the market situation. Not only with gold, but there was also silver was a big one. You had the Nelson Bunker Hunt issue with silver, and you had some other things that were going on in the markets that caused a ripple effect throughout a number of different markets, and including gold, and drove gold up to 873 because everybody thought inflation was totally out of hand and we would never see the end of the ongoing rise in prices. Well, as you know, after that, gold kind of backed down. If you're looking at a long-term chart, you had kind of a lethargic period basically between 1997 and the middle 2005. You could actually call those years and that stretch in there kind of a giant saucer bottom, if you're familiar with that technique in traditional technical analysis. And finally, the gold price edged above $400 an ounce, and then it kept moving to the upside. It hit $1,000 for the first time in March 2008. And if you recall that 2008 time frame, that's when various grains and soybeans were setting new highs. Oil was on its way to its peak, and again, it looked like we were off to the races, and again, the market backed down. We are going to talk about kind of how to play a trend and what is going on in the trend. We are looking here at the gold chart, goes back a year, and we're going to be looking at how are we going to play this trend. Obviously, when you look at the longer-term market, you have to conclude, well, without much doubt, that looks like an uptrend. You have higher highs, higher lows. You have a lot of little wrinkles in between, and that's what we're going to try to sort out as to how we're going to try to manage a position like that in the market as the price moves up. We have several different indicators that we have on the screen already. The first that we have there is in the Vantage Point software. It is called the Triple Cross system. It is a series of 3 exponential moving averages. We have the red one, the little red line that you see there, which is a 3-day exponential. The middle line there is the blue, and that's an 8-day exponential moving average, and then the longer term one is an 18-day exponential moving average. I think probably if you're a long-term trader and you're kind of intent on keeping with the trend and sticking with it, one of the ones you want to watch pretty closely is that green line. What is the angle of the green line? Right here, of course, it's up. Where does that turn come? We have situations here where the green line does turn down, and not quite as simple as saying, okay, when the green line turns down, we're going short, because it doesn't really tell you where to be short at. But the angle of that green line and the crossover situations with the other moving averages does provide clues as to when the momentum has shifted and the market is starting to turn. On the bottom portion of the screen, you'll see a couple of other Vantage Point indicators that are useful, particularly in getting into a trend and getting started, and we'll talk about those a little bit because it's important that we know a little bit about some of those indicators and what they are telling us. First that we have here is that gray line. That gray line that you see is the predicted Neuro Index. The predicted Neuro Index is a comparison of two 3-day moving averages, a predicted moving average and an actual moving average. And again, we're talking about typical prices. It will say or forecast whether the price, typical price, will be up in 2 days or whether it will be down. If it looks like the forecast is up, then it will give a reading of 1. If it looks like the forecast is down, you will have a reading of 0. So it's either bullish or bearish, on a short-term basis when we're only talking a 2-day time frame, which is pretty useful when you're starting to get into a market and wanting to know at what point you might get into this trend. So, we have that kind of an indication from the Neuro Index. Now the other lines that you see there are blue and green lines on the bottom part of your screen, and those are called the predicted differences. What they are is the difference between a predicted moving average and an actual moving average. The blue line that you see there is a comparison of medium-term moving averages. The actual the green line that you see there is long-term moving averages. You'll notice up above that when the market kind of starts to narrow in here and and where it's going, that will be reflected on the chart up above, but it's more difficult to pick out here kind of when those types of things are narrowing than it is when you're looking at the indicators down below here where they start to turn. For example, where it starts to turn here. In general, this is a momentum indicator. The predicted differences provide a clue as to the momentum of the market. Logically, you can expect the medium term to turn more quickly, and that's kind of like a little early alert, a warning that something may be afoot. So you need to kind of watch what is going on the chart itself and when there might be a crossover or what might be occurring there. The crossover situations that you'll see, for example, there's a crossover there where the blue line crosses below the green line, suggests there is some weakness ahead. Sometimes that weakness is reflected immediately in prices. Sometimes it's a little early, so it's not the only indicator. None of these indicators are used in isolation. You have to keep them using all these indicators together. A couple of other things about the predicted difference that is important to note is that we have a situation on the zero line. You see that line is going down through the center here. This line right here, that zero line indicates the difference between a weakening type of a market situation and a strengthening type market situation. Above the zero, of course, means a little more strength, and you can see that reflected on the prices up above. Below, it's a sign of weakness, and you can see that also. Another point about the predicted differences that can be useful, and if you're familiar with indicators and what indicators quite often tell you whether it's an overbought, oversold type situation, is that when you look across over a period of time, this is a 1-year chart, you will see that when it gets to $20 above the zero line, or let's get it on the $20 below the zero line, that these act as more or less boundaries. And you're familiar that when markets move to those boundaries, if it's above, that indicates an overbought type situation, and below indicates an oversold type situation. So that's another way to use a predicted differences. When they go to the extreme, they drop to the lows, then you are in a position where you might expect some kind of a turn.